All right, folks, welcome back to the Property Couch podcast. And today is a very exciting day for us. We get back to the origins and the roots of the podcast in the very beginning and how we can protect our community and protect the flock, because we're calling on some lessons from some titans of investing, Ben. How do we pull it all together?
Well, Bryce, we think about their philosophies. We think about how they look at the world and how they execute on great investment strategies and how they think long term. And in what's making property news, it's population forecasting time, Bryce. We're seeing where the population is in Australia because population equals future housing demand. So hang around till the end of the show where we reveal where everyone's moving.
Let's rip into it now.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. And, of course, welcome back to you too, mate. We're back in town, but we've spent the week in Sydney on a book tour.
We did, yes. So we've been very fortunate to get out there and talk about our book up in Sydney. We've done a few podcasts. We've also been on the Sunrise program and also the AusBiz, the property show. So, yeah, there's a bit. We've been pretty active over the last couple of days up in Sydney.
Yeah, it was fun. But Mum was happy. You know, we're back on the telly, Ben. We're back on the telly. But the idea is we're obviously going around and talking to folks about something that we're really passionate about. But, hey, wasn't it a fun night on Tuesday night when we got to meet Property Couch listeners? That was
it was great. It was really nice. I mean, obviously we talked a lot about, some of the important aspects of the book and just good to mingle with our community. It was just really lovely. Really lovely.
So thanks for those people who turned up and pressed the flesh. And I said this, I think I said it last week, you and I talk to a microphone, we look at each other like we have for the last 10 years, but it's nice to actually talk to the people that that we've been called to serve. Hey, tell us a bit more about this. Well, it's more of a reminder, really.
Just a quick reminder. A quick reminder again in the show notes. You'll see the link to the New South Wales petition. No grounds evictions. It's gone too far. There's no reasonable grounds in there at all. Basically, we need to get the balance right, and it's not in our favour at the moment. So from that point of view, we obviously need to get more and more people signing up to that petition. So there's information there in which you can read. And then obviously great to have your name on that petition.
But great to have your name on the petition, folks. Hey, my mindset minute theme today is the great Stoic philosopher, Ben Marcus Aurelius, once reminded us that we suffer more in imagination than in reality. True peace isn't found by fixing the world around us. It's found by mastering the world within us. Drop the mic, Ben. Drop the mic on that one. When you stop reacting to every little thing and start choosing what deserves your energy, you begin to live, not just exist. I love that, Ben. I've got a new coach. His name's William Whitecloud. He wrote a book called The Magician's Way. And it is one of the key messages is your focus becomes your reality. And sort of teaches you not to have your thoughts and feelings being your being the master. They are the servant to you. And I just really like that. True peace isn't found by fixing the world around us. It's found by mastering the world within us. It's the sooner we realize that no one's thinking about us, the sooner we realize that the checkup is from the neck up, the quicker we just have a bit more peace and contentment in our life. So I figured I would drop that on our community this week for them to marinate as they go in.
Very thought-provoking.
Into the weekend. Hey, we are talking today about some titans of wealth. We want to talk about what some of the greatest investors know that possibly we don't. And
we should.
And we should. And it really came as an idea that you and I had. We caught up couple of weeks back, we're having dinner, we're walking down the street, and you and I were riffing this idea. And I think it really stems from the fact that when we started the podcast way back in the Boondocks, Ben, we didn't we didn't want to sell any hype. We wanted to. It legitimately started as a way for us to help people and protect people. And if you go to the front page, the opening description of this book is all about $10 haircuts. It's episode number 1 in our podcast, and that's really been the mission of what we've been trying to do, is to throw rocks at the enemies of financial transformation. And so today we really want to pause and reflect on that. And we're drawing on some of the titans in the investing world around the world, and see what we can learn from those folks, Ben. So I'm excited about this one.
Yeah, I think, at the end of the day, our mission is to help aspiring Australians build knowledge, financial literacy. This is obviously the Property Couch podcast, money management, property finances, all of those things woven in to help people make their informed decisions. And to your point around fixing bad haircuts, we're really trying to move away from this concept of, there's a lot of money to be made in terms of commissions and fees to be made in property. It's a high ticket item, so it attracts a lot of people into this particular space. So we've had the Spruikers, and I think we've done a really good job of bringing awareness to off the plan and house and land package risks. But if you haven't listened to those episodes, jump on to obviously our support tool on WhatsApp in terms of, to help get some information around that. That's our TPC companion to sort of talk about those types of things. But now we're also seeing a bit of strategy stuff, the latest pump up markets and driving properties higher, so they can basically say, look at the clients that we've put in there. And there's a lot of people who are experimenting with trust lending and a few other things. And so I get a little worried with, this type of sort of sentiment shift into this hype area, because I just don't think that it's going to be sustainable. So our approach has always been about cutting through that noise and teaching those fundamentals to empower our audience. It's pretty simple.
And we do operate, you and I are parents of young kids, Ben, so we do operate in an environment where distraction is real, and quick results and low attention spans are the norm. And so what we want to do today is talk to the timeless principles that some of the titans have been using to get their success, and see how they might apply, and see just have a little reset and remind our audience that sometimes the chasing around the shiny objects, and when you're not, you can feel like you're missing out on the party. But we hopefully will reinforce some things. Hopefully we'll learn some things from some of these titans. But also the whole goal of this episode is to get people to reflect and think about, okay, this is the environment that I am a part of, but do I want to meet the environment, or do I actually want to go and meet my goal, which is to actually have a passive income that exceeds my expenses, so that I can live in perpetuity into the future without having to trade my time for money. So that's really the way that we're setting up for today.
Yeah, we became a top 10 business podcast, and what we're about to unpack today, a lot rings true in terms of what we do. So we shared and taught the frameworks, the research thinking that we do, the property investment principles that we hold, dear in terms of to shape up that long-term thinking and that long-term return. Because at the end of the day, we're about building or helping people build financial security for themselves and their family. And I think that's what we're zooming in today, because in terms of the principles that Bryce and I teach are the principles that we also use in our own personal investing, but also principles that we do in terms of the work that we do. And so I think from that point of view, this is a timely reminder for some, and hopefully an introduction for others.
Yeah, okay. So 5 titans we're going to cover today, Ben. The first one is Ray Dalio, who's the master of the microcycles. So if you're not familiar with Ray Dalio, super successful investor. He's the founder of Bridgewater Associates. He started investing at age 12, buying shares of Northwest Airlines after overhearing a tip from caddies at the golf course where he worked. By 26, he founded Bridgewater Associates from his 2-bedroom apartments. So there's your quintessential garage story, if you like, Ben. In 1982, after confidently predicting an economic collapse that didn't happen, he lost everything. His clients, his staff, and nearly his reputation. That's important because there's a pivot going on here. So instead of quitting, he reflected deeply, built new principles around radical transparency, and began meticulously studying centuries of economic history. Underline, bold, italic. He was a student of history from that point forward, Ben. So that system became the foundation for Bridgewater's legendary macro investing model, now one of the largest hedge funds in the world, Ben. So there is a foundation here that suggests that you probably should stand up and have a little listen. So his philosophy was understand long-term cycles. So get under the bonnet and understand, and don't be too overexposed to debt. Understand how inflation works and understand the cycles around interest rates. He said to diversify for resilience, not just return, and prepare for the future. Don't try and predict it. Wow. Have a look at that. So there's
and for those of you who don't know about his book, Changing World Order, that's been released, I think it was last year.
Yeah.
I think it was when it first came out. It's it's an interesting read about thinking about empires and how those things change. So when he does say centuries of business history, he really means it, and obviously he's got a big story around, government debt and how empires fall over because of their debt. So fascinating stuff. But, back to the conversation at point here, that those philosophies about understanding those cycles is really powerful for us to take away those lessons.
And he's got this quote, Ben, that he who lives by the crystal ball is destined to eat ground glass. Take that. So he's not interested in trying to predict the future. He's interested in actually just building a fundamental that says, I'm going to be here around for a long period of time, and I want to build a structural foundation that that supports that. So how does that tie into the property couch philosophy, Ben? Quite simply, it's building a portfolio that can withstand interest rates, rises, inflation, and credit tightening. We've actually seen that it's never been, it's just in the front of our nose. It's a very close look in the rear vision mirror around that. So that not only works in boom conditions, but works in all conditions. So let's talk to that point first, Ben.
Yeah, well, I think at the end of the day, we all want to make sure that we're investing in the right locations. We all want to make sure that when we're doing our plans that we can withstand changes in interest rates. So that's cash flow modeling, all the stuff we talk about, plan to become what you plan to become. Inflation, property is a good hedge against inflation. So we know that once we own the land and also the improvements on the land, if those improvements can hang around for a long period of time, that's also going to be, really powerful for us. And then, obviously we want to make sure that we've got the appropriate credit and, cost-effective credit, but we do use credit as part of what we're doing. So understanding that is also about that. And then it goes on to talk about using buffers, right? And buffers, you need to consider future lending conditions, and, you don't want to overexpose yourself to short-term hype and optimism, in terms of, we can all be super optimistic, and that's fine. I class myself as an optimist, but what I'm trying to do is look past the hype cycle and then look into the sustainable cycle. And that's why when especially when you bring debt into the conversation or leverage into any conversation, you don't want to be in a volatile market. So residential property, an essential need, something that we all have to live in, the land around the productive use, the economic activity that's happening around those big urban centres. We looked at that in terms of recently with that Jeffrey West, the Professor Jeffrey, all of those. So there is some really great clues in terms of that. And
I like
ultimately
too, Ben, because it's, our plan is 2 or 3 investment properties.
Yeah.
And so it's not 10, it's not 6, it's not 7, it's 2 or 3, generally speaking, right? So because we are aware that there are moments in history where you could actually have got multiple properties in those periods of time, but then now being able to get access to the same funding that you were back then is really not possible.
I mean, we've been around long enough since the GFC, the Great Financial Crisis, and the global financial crisis. They call it the Great, we call it the global, because the US world just lives in their own sphere.
Yeah.
But we could have bought 100 properties, Bryce, in Chicago, right, in downtown Chicago, for probably $2,500 each. Now, even today, those particular neighbourhoods, all of that's just been demolished. They've just reset in terms of what happened, in those particular markets. And that is a classic case of the economic cycle. I mean, Detroit and Chicago and these big industrial centres where they built ships and they built cars and all of those things. Well, when their markets fell on their bums, the economic activity wasn't there. The marketplace collapsed. The opportunities collapsed. And so that's ultimately a great story in terms of looking at these longer term cycles and the importance of the big economic centres that drive that economic growth.
So if you want to think like Dalio, prepare, diversify, and avoid betting your future on a single market call. You learned that the hard way. So that single market call is something we really want to lean in on. Okay, so number 2, Titan, is Howard Marks, who was the cycle watcher. So he's the co-founder of Oak Tree Capital. Howard cut his teeth during the high-yield bond boom of the 1980s. While others were chasing high returns, Mark focused obsessively on risk management and market psychology. He founded Oak Tree Capital in 1995 with a laser focus on distressed debt and value opportunities, stepping into markets where others fled. He rose to fame for his now iconic investor memos, plain-spoken, insightful letters that decode market behavior, sentiment, and cycles. His writing, and listen to this, his writing is so revered that even Warren Buffett has said, when I see memos from Howard Marks, I read them first. Right? So that's high praise there, right?
That's strong endorsement.
Heavyweight, Titan, qualifier. So his philosophy is you can't predict, but you can prepare. Okay, there's something similar there from Dalio. Recognize where you are in the cycle and focus on risk first, not return. So that's really beginning with the end in mind. But his quote is, the most important thing is not what you buy, it's what you pay and when you buy it. So there's a fair bit in there, Ben.
Yeah, it is. And I mean, I think from the way in which I look at that, I mean, yeah, he is an opportune investor. He's a patient investor. So, and, the work that they do and the fundamental research that they do just brings up those opportunities. You could say in respect of, how he's basically going about it, how that ties into the way we think about the world here at the Property Couch is that Marx reminds us of the risks in what we don't see coming, right? So obviously, black swan events are events that we don't necessarily see coming. So we need to make sure that we think about those types of things and, we don't invest at any price in any market. We basically share that, reduce that risk. We talk about A, B, C, D. Defense, part of our defense is basically saying, what is the economic stability like? What is the future of this city, town, region? What's the economic drivers? What's going to keep going forward? How is it being managed? All of those things come into that longer term view. And what we've also said, great properties are bought, with, not in frothy suburbs at the wrong time. They can be super poor investments. And so we need to make sure that we're not getting sucked in to the latest fad or the latest hotspot or whatever that looks like.
Yeah, so therefore our focus on that sort of getting in the counter-cyclical buying cycle and holding power, that's straight out of Mark's playbook. So I think what I liked, what you said before, Ben, is he reminds us that the risk is what you don't see coming. And that's probably the thing that I'd love to really reinforce and underline for our audience, because a lot of the messaging is, in our view, Ben, lacks a bit of margin of safety, right?
A lot in some respects, yeah.
So, but it sounds good and it sounds sexy, and for a distracted, impatient audience, it can sound pretty good. But these guys have been through multiple cycles. Started back in the 90s, That's a lot of history there. That's 30 years of history, and obviously has an incredible amount of success during that time. So,
and I'll keep reminding Bryce, for those new to our community, all current indicators such as demand and supply and sentiment can tell a pretty compelling short-term story. Next 1 or 2 years looks potentially tremendous. All the ducks are lining up. But property isn't an easily transactionable asset. It has a lot of entry costs and exit costs in getting into that, plus capital gains tax. So, you've got to be thinking about that, because what we see and hear are these quick wins and return on invested capital as being really, really strong. But then what happens next? What happens to those markets where, the claims are being made that the price doubled in 3 years or 5 years? What happened after that 3 or 5 year period? Did they double again?
Did they give it back?
Did they stay flat? Did they go backwards? What was, because once the sentiment moves on, and every market has economic cycles, right? It's just the nature of a capitalist system that you will have these spikes and these troughs. It's just they're very, very hard not to come into those cycles, because we do overspend and then eventually it has to be corrected and pulled back. And especially with so much debt in economies around the world, that's what happens. They have these sort of higher highs and lower lows, and that volatility. So we need to basically say, to look beyond that 1, 2, 3 year window and look into the what's going to happen in a decade or 2 decades or 3 decades. We need to look at the demographic profile and the population profile of those centres and say to ourselves, okay, well, where does all of that older population go? Well, unfortunately, they pass away. But you still got all this stock available. And I think a great example here, Bryce, is Japan. Japan is one of the best examples where they've effectively had their money system propped up for decades, for absolutely decades. And because they take no immigration, literally zero immigration, their property market has tanked on all centres, because as that ageing population gone, we've got all this property that no one needs or buys. And so they've got a demographic problem, and that's showing up in terms of their prices for their properties. Now, in the 80s, when Japan was booming, property prices were scorchingly hot. And you would think supply and demand and, cost per square metre of land, productive use in those bigger centres and some of the bigger regional cities that had the fast trains and all that, all of those property markets have subsided except for their fundamental big mega centres, which have also continued to maintain their level of property prices. So it really is important, population over the decades, not in the short term. Population doesn't show up as an indicator in supply and demand in the short term, but in the longer term, it absolutely plays a critical role in the level of people who need shelter versus those who don't. So immigration has to be part of the superpower that we've got to be thinking about for the medium to long term for property prices.
Right, well said. Howard Marks is really reinforcing margin of safety there. The next Titan that we wanted to study, Ben, this list would be incomplete if it didn't have this person in, would be Charlie Munger, the philosopher capitalist. So he's the former vice chairman of Berkshire Hathaway. He's the only person on this list, Ben, who's no longer with us, having died in November 2023. Charlie Munger grew up during the Great Depression, served as a meteorologist in the Army Air Corps, then trained as a lawyer before entering investing. He first met Uncle Warren in 1959, and the two clicked immediately. It was Buffett. It was Munger. That's a combination between Munger and Buffett. It was Munger who steered Buffett away from cigar butt investing, which is, buying those extremely cheap failing business, and towards buying great companies at fair prices. And that's where that philosophy was first introduced. He's known for wit, blunt wisdom, and a love of mental models, using principles from psychology, physics, and biology to guide decision-making. And it obviously formed the backdrop to the elephants and how do they predict prices episode a couple of weeks ago, Ben. He's a lifelong learner and reads hundreds of books a year, and famously said, I have nothing to add, when he's already made the point brilliantly. So let's talk about his philosophy, his well-known quote, Ben, and then you can lead us into how that ties into the Property Couch philosophy. But he, number one, avoid stupid decisions before chasing clever ones. Number two is use inversion, figure out what not to do. I reckon that's one of his greatest contributions.
One of his superpowers.
And then three, invest with patience and discipline. So stupid decision, avoid stupid decisions, use inversion, and invest with patience and discipline. And of course, we've quoted this before, Ben, many times. I think it can't be over-quoted because he says the big money is not in the buying or the selling, but in the waiting. And that's the bit that most people don't want to do. They can't be bothered with the waiting, Ben. So tie that into the Property Couch philosophy for us.
Well, I think it's first important to talk about this inversion concept. So this inversion concept is having a theory and looking at a probability in terms of how strong your view is on that, and test its inversion in terms of its likeliness to happen, or what would be the different course of action. So it's almost like, you draw this sort of life's journey and all of these sort of innovation, and then there's all these different things that are forking off that, as you're sort of thinking about how innovation works and technology works and life in general and health matters and all that. And then just start looking at the inversion of those things in terms of what still remains stable. What still remains stable is we need to eat, we need shelter, we need clothing, we need, all of these things. We need financial services, we need insurances. Those types of things are a big part of that. Now, how that ties into the Property Couch from our point of view is Munger is all about avoiding dumb decisions.
Oof.
And that's
like he's quoting you, Ben.
Like at the end of the day, we're just trying to help you make less mistakes. There will be mistakes made. Even Berkshire Hathaway, Warren, Charlie, they've made mistakes over the journey. In fact, when they met was the clothing business or the textile business that Warren was doing his best to try and turn around, but it was just near impossible over that time. So that's when he started to think differently about that. Coming back to how it ties into how we think, not only at the Property Couch, but also how we think in terms of our general investment thesis and advice, is don't buy based on FOMO. Don't based on fear of missing out. We always say the best time to buy is when you can buy and hold for the long term, not necessarily racing into a market that's already hot. It's just basically line up your cash flows, find your surpluses, and just get to work. And then just buy the best opportunity that you can find in the marketplace. And then, the big money is in the waiting. It's not necessarily in the buying and the selling. So that becomes a really important point. Don't overextend. Well, if you've got a plan, you won't, because you'll see all those future purchases and future costs that are coming into your household, children, schooling, travel, whatever that may look like. So again, that you can afford, and try and avoid the hype. I mean, there's a bit of a theme around hype coming through here, Bryce, isn't there? But that's really important. What else was in the? What else ties into what we're sort of talking about?
Well, yeah, to your point, the hype's the enemy. That's I reckon that's the bit that we're trying to educate our audience on. Is the hype is where the real danger is in the next part of the cycle with some of that proliferation of information that's out there. But look, we have a commitment to a structured strategy. To your point, that's the planning. We have logical suburb selection based on technical and fundamental, with the underlying principle that location does 80% of the heavy lifting. And then we have a very clear plan for the lending. To his earlier point, not overextending, but we are very much in making sure that our households remain liquid, that they remain solvent. So that's really 101 Munger there. But the inversion principle. Some people don't know what, I use the term rich just as the comparison to poor, Ben, but some people don't know why they want to be rich, because it sort of in society, it's frowned upon to do that. But sometimes it's easier to invert using his principle and go, why don't I want to be poor? And it's for this reason and this reason and this reason and this reason and this reason, which then helps you get the opposite for why you want to actually have some nest egg and wealth. So that is Charlie Munger. Number 4 is Peter Lynch, the common sense investor. For those not familiar with Peter Lynch, he's the former manager of the Fidelity Magellan Fund. Peter grew up in Boston and started his career at Fidelity as an intern. He eventually took over the Magellan Fund in 1977, Ben, when I was 2, and ran it for 13 years with astonishing success. Under his management, the fund returned an average of 29% per year, growing from 18 million to 14 billion. Lynch's superpower, seeing investment opportunities in everyday life. And I think you'll see in a second what that looks like, from shopping centres to product packaging. He believed the average person often had a better edge than Wall Street analysts simply by paying attention to what was happening around them. He's also known for demystifying investing with humour and humility, writing books like One Up on Wall Street that encouraged everyday people to take control of their financial future. So here's the philosophy. Here's the philosophy is this: invest in what you understand. Okay, that's a good philosophy. The best insights often come from your daily life through observation, Ben. Maybe walking around the suburbs yourself, and don't overcomplicate it. Just know your asset. Don't invest in something that you don't understand fully. So there we go. That's a little backstory, but kick us off where you want to, Ben.
Well, I think a lot of aspiring people and a lot of Australians and people in most Western societies who their economies are growing and there's greater GDP from Singapore to Sydney, even in obviously to the classic centres of New York, etc., and even San Francisco and and the Valley. In terms of that, and that is that property prices in those areas go okay, because the reality is that land is scarce and people want to get in there. So how that ties into our philosophy is understanding the everyday man. Like, in terms of the things that they're investing around shopping centres and product packaging, well, yeah, great packaging around a product helps sell the product. So, and we're always going to be selling products in a capitalist society. So if you can do the packaging and you can do it really well, or you can invest in the businesses that make the packaging and they do it, you can obviously make a return on investment. And I think that's a really powerful point. So in our case, you don't need to be a genius to buy good investment properties. You just need to understand it. And I think a lot of people have a basic understanding, but they can still make mistakes about thinking that every property goes up in value when we've proven that it's not. Even in the latest pain and gain report from Cotality, we saw that 93% of the sales of recent property ended up in a gain, but there's still 7% that didn't. And there's still people sitting on negative equity or, from what they paid for it for what it's worth. We've highlighted that many a time about, what types of properties to buy, but understanding the concept of what it is that appreciates and what depreciates is a good part of that point. And if you can't explain the investment case for the suburb, for the property and for the tenant to your kids or your partner, you probably shouldn't buy it. Like, this is what I keep saying. If you're selling it on a recency bias, like everyone's going there, it's a great lifestyle location, everything's going to go okay, and it's a building material. Well, what's gonna sustain it? What's the economic engine that's going to keep producing that security? And if you can explain that, and that's going to be around for the decades to come, then it's going to be a pretty safe bet.
Yeah, I think what I think about that, if you can't explain it, is most people can explain the owner-occupier appeal because it's something that they eat and sleep and breathe every day. But it's when it starts getting into investor appeal and some of the complexities around that investor appeal, that's what my mind goes to with that. But look, I think that Lynch would probably love our approach of, on the ground suburb research, the demographic insights that we put into it, and the local knowledge. I think that's what he's saying is the power of the people is usually observed at the street level. It's not normally observed at the ivory tower level. So I think that's something that we can take away. Clearly, a very successful investor over the journey, 29% per year. That's incredible. But going from 18 million to 14 billion, clearly that's someone that we should pay attention to. And then the fifth Titan, Ben, I thought it was a bit cliche if I started with this one, so I've ended with this one, but I think most people would be surprised if we excluded this man. But of course, I am talking about the Oracle of Omaha, Warren Buffett, who made his first investment, or he's the CEO of Berkshire Hathaway, and made his first investment at 11, filed his first tax return at 13 and had already bought a pinball machine business by his teens. So he was a big student of Benjamin Graham at from Columbia University, and returned to Omaha and began building an investment track record that's become the stuff of legend. But Buffett's genius lies in clarity, discipline, and simplicity. Really take those to heart, folks. While others get caught up in the complexity, he focuses on buying great businesses with strong moats, then holding them forever. Coke, Apple, although there's an update on Apple, American Express. These are more than investments to Buffett. They're compounders bought with a long-term mindset. He's also a teacher at heart, and his annual shareholder letters communicated timeless truths with humility and humor. And this is the most fascinating part, I think. And if you've seen the series on Netflix about this man, he bought a house in Omaha in 1958 and still lives there. Oof, imagine that.
He's obviously one of the better books about him is his essay letters. You can get you can buy that book. I've had the audio book for a long time on that one. Something that I can often reference from time to time. Interestingly enough, Apple is still their biggest holding at Berkshire Hathaway. They still hold around $41 billion worth of Apple shares. But just goes to show you, even though Apple mightn't be at the forefront of the current AI race, they are a very, very profitable business, and they have devices, hardware and software that's loved by billions of people around the planet. So it's definitely something to look at there. And then if you think about his philosophy, it's buy quality with a moat. So, in our case, the moat is the scarcity of the land and the proximity of the land and the productive use of the land. You put those two things together, you basically have a margin of safety. Built in.
100%.
Margin of safety built in. Be greedy when others are fearful is the classic line in terms of that's about buying it at a fair price, and let compound do the work over time. It's just basically, as Charlie Munger said, the big returns are in the wait, in terms of just sitting down and letting them do their thing.
So his favourite quote, his one of his well-known quotes is his favourite holding period is forever. And this is where we tie it into our philosophy. You'd never find Buffett flipping properties. He'd just buy quality and hold them through all the noise. He'd buy A-grade assets. He'd go for we're obviously speaking on his behalf, but using his philosophies and his public teachings, he'd buy in locations with strong moats. So think infrastructure and scarcity and schools and amenities and all the things that we talk about that come from being around the big cities and the flywheel that turns that through. So that's why we structure finance in a way to build a moat around the investor. Rate rises, recessions, media panic, insert whatever you want to put at this point. I think that really aligns closely to the philosophy of this fifth titan in our list, Ben. So let's talk about some common threads. You want to kick it off? What have you noticed about what ties these five legends together, Ben?
Well, after trying to build up poor performing businesses and flipping them for a profit, Warren learnt not to flip. So the latest version of Warren, or the version from Warren for probably the last 50 years, is he would never flip properties. He would buy the quality properties and hold on to them for the long term, and that's, he would just trade through the noise, wouldn't be too worried about the noise. He would be checking the economic fundamentals to make sure that, the economy is moving well, which is attracting new talent into that economy, which is always putting that underlying pressure on the supply of accommodation in that particular area. So that's point number one. In terms of what he's trying to do and what people invest in Berkshire Hathaway to do is they buy A-grade assets. Okay, and we always talk about owner-occupier appeal in locations with strong moats. Well, the strong moats, we've talked about them a moment ago in terms of holding a good land content, in terms of being close to all of the lifestyle and productive amenity, that makes it attractive, that potentially also has status. We talk about how property is one of the great ways in which we can express our success. And people like doing that in this, era of social media and social envy, that also comes into that point there. So it's about those locations and the types of assets that you're buying in those areas, and you're thinking about that infrastructure, that scarcity, and those types of amenities and schools around those areas.
And then the other thing that ties them all together is just this supreme quiet confidence in the long game. So they had a very clear strategy via frameworks, mental models, principles, systems. They just invested in the underlying decades philosophy, not the what's happening in the hot tips and being the loudest voice and flashy and all those sorts of things. So there is some really common threads here, but Ben, I just get that. I get that patience is not sexy. I get that there's much more sexier philosophies that we could talk to, but these guys are the ones that are showing that over multiple cycles, over multiple decades, having seen, we're talking about 30 years as a minimum for some of these titans. Some of the things that they would have seen come and go and how they would have refined their philosophy over time was, I think that's something that I would like for our audience to really bake into their thinking, because we get that they're being bombarded with other images, philosophies, and messages, but we don't want it to be fool's gold where they go and chase some of that shiny stuff that then later on realizes that if they had of over a period of time having given some of that back, or been stuck in markets that were something that these titans would never have ever considered. We're trying to avoid that. We're trying to upgrade the fact that you still don't want to get a $10 haircut, man.
No, you don't. And Bryce, as a young 20-something male who probably had fantasized talents, beliefs of themselves, when I started reading all this stuff, I wanted to be the next Warren Buffett. I wanted to, be the next person who had this ability to, do all of this amazing work. Well, I can tell you that there's another couple of common traits that these guys have, and that is they've dedicated their entire life to their specialization. They live, breathe, think, do everything to do with that business or that company, and they have achieved the spoils off the back of their frameworks, their principles, their systems. But when you're a mere mortal, not like these superstars, you've got to ask yourself one simple question: have I got the energy and the time to do this myself? If you have the energy and the time, go for gold. Dedicate your entire life. Make it your purpose and your mission and your business, and just go. This is your Olympics. Go forth and conquer. But the vast majority of us, Bryce, we actually want to have a lifestyle. We want to have, memories. We want to have that. And so once you realize it's going to completely dominate your life, and it's going to be everything you do, including some of them had failed marriages and all of those other things, including, the Oracle of Omaha. So it's an important message here to sort of say, if you want to replicate these systems, but not have to do all the work, you effectively look at investing in Berkshire or investing in some of these platforms, or, getting some talented professionals to be able to help you as part of that, because they've proven to you, don't chase the hype. Don't chase the hot spots, the silver bullets, the get rich. They don't do that. It's sustained pressure, sustained effort, sustained outcome, and that just basically gets you to that ultimate outcome. And then, they haven't necessarily been the loudest voice in the room, but they've been around for decades. And the longer that they're around, they don't need to be the loudest voice. They just need to be the voice of reason. They just need to be the voice, no flashy, no sales pitches, just strong fundamentals backed by evidence-based research that they're doing. I think there's another message in there. What they have all had was quiet confidence in their long game. So again, I keep coming back to the strategies, the long game strategies via clear investment frameworks, principles, and systems. Those things matter. And if you're ever going to invest, or if you're ever going to see a financial planner or an investment advisor, ask them what's their philosophies, what's their systems, what's their approach, how's it evidence-based, what are they doing for you? So you know what the journey is that they're going to take your money on and your investment dollars on as part of that journey.
So as we wrap this up, folks, the idea of starting the podcast was to help protect people from making decisions. I think to Ben's earlier point, we feel like we've exposed the spruikers. We feel like we've exposed the brand new myth. And really today was just to remind folks to come back to the fundamentals of if we've helped you avoid what not to do, we want to actually encourage you what to do. And that's really what today is about. It's worked in our own portfolios. We are now both in our third decade of investing. So we're not talking about something that we haven't experienced ourselves in our own portfolios. There are plenty of players in the space that are in their first decade. There's plenty of players in the space that are in their first half decade. So I guess really how I want to wrap this up, Ben, is before you get caught up in sort of the next big thing, just ask yourself this: what would Warren do? What would Charlie do? What would Mark do? What would Ray do? What would these titans do if they were given the advice that's been given to you? Would they invest it, or would they just continue on playing the long game with clear thinking around all of the things that they know got them into the investment in the first place?
Yeah, and you know, I just want to remind people that we get it. I mean, these days, if you have an interest in investing like we do, we know what comes up in our social feeds, you know, on our Instagrams or our Facebooks or even, you know, Twitter or X, I should say, and all of it is you start getting these feeds and also YouTube for that matter, you know, of these big opportunities and these next big ways to make wealth or passive income or change your life. And I get the marketing spin. And what I wanted to just remind people of is the behavioral science perspective. There's a really strong bias here, and it's called survivorship bias. And effectively what's happening is that you're hearing about their wins and how wonderful their life is. They're showing you this amazing lifestyle that they've been able to show for themselves. But usually it's such a powerful bias because we call it survivorship bias because they're only talking about those. They're not talking about the losses. They're not talking about the fact that, you know, they're part of the 1% club that's very, very hard to get to and not everyone's going to do it. And they're trying to sell you something. So I would always, you know, when you start to get these feeds coming through, is just take stock and say to yourself, all right, what's the fundamentals look like here? Am I going to get into the business of doing this myself? Or do I need someone to just, you know, take a more calm approach, potentially a more passive approach? And do I need to get some professional advice around that? And I think if you take those messages, you'll avoid making silly mistakes. You'll avoid sort of becoming the next day trader that comes around by doing options and all these sort of fancy financial instruments and, you know, doing foreign exchange and all that. The percentages of people who make it in that space are 0.0001, but they're telling you all about it, right? Because they're telling you about their wins because they've got a software package to sell you, or, you know, they've got a course to promote for you. And I think that's the message for me here is those algorithms are teasing you about these quick wins and instant gains. And we're trying to say, well, that's not what the Titans do. That's not what they do. What the Titans have done is got a system, got a process, got a framework, and they've worked through that. And we hope through the 10 years, the 550 odd episodes that we've done, is we've been consistent on our frameworks, being consistent on our principles, our investment principles, and they have served people very, very well over not only the last decade, but potentially the 2 decades that we've been operating in terms of helping people financially transform their lives.
These Titans of investing learn not to speculate or get seduced by the latest trends. They learn to build and follow timeless frameworks, principles, and systems. That's what we've hoped that we shared through this episode today. Hey, my life by design hack today, Ben, is I found this scrolling through, which I think was super. Actually, I think Andy might have sent it to me.
Okay, yeah.
So what we'll do is we'll get Ardit to play it now, and then I'll come back and speak to it.
If you're someone that needs to keep receipts for work or for tax, then this hack is going to change your life.
Okay, so first we're gonna open Photos and scroll down to Albums. And then what we're gonna do is create a new album and we're gonna call it Receipts. Did I have to Google how to spell receipts for this video? Yes. So now you're gonna wanna go to the Shortcuts app, open that up. And then in the top right-hand corner, click the little plus, and then we can rename it up the top here. We'll call it Receipt Capture. You can also change the icon, logo, and color. There's literally a million of them, but I like this barcode because it like gives receipt, you know? Okay, so now tap Search Actions and write Take Photo and press that one. So at the bottom, click Search Actions again and search up Save to Photos. And then we're gonna change Save Photo to Recent. We're gonna change that to our Receipts folder. So now what we can do, this is the coolest part, now we can save it to our control center. So once you tap it, it'll launch a camera. So let's use this receipt as an example. So you take a photo of it, and then it's gonna ask you if you wanna use this photo. Obviously you can retake it if you want. So hit Use Photo, little tick, and that's it. If we go back to Photos, you'll see it's added it to the Receipts folder. Depending how often you would use this, you can even go one step further and save this to your lock screen or even your action button.
Save this video if you're gonna do this, or send this to a friend who is a serial receipt collector.
So what I love about that, Ben, is it's an automated way for a lot of people, particularly at this time of the year around tax time, that you take a photo of your receipts by setting up that quick shortcut onto your command center on your phone. And then all of a sudden, you don't have to worry about that, because receipts are the enemy at this time of the year with the shoe boxes and all that sort of stuff. But you need to have some form of automated way to do that via your phone, and do it in the moment, as I always say.
Yeah.
I do it in Dropbox, right? But that's another hack that you've just seen there. But ultimately, when I'm at the petrol station or if I'm at the point of sale, I just do it then, because it takes me, 20 seconds to get it done, because I've got an automated system. But when it's at the end of the year, when it's a shoebox and you've got to sort it and you've got to go through it and you've got no system. So that's why I thought that'd be a really good hack for people saving receipts to a folder on your phone.
Well, mate, it's the first time I've seen it, and I can tell you that we are working on something very similar, more in terms of with CSV filed into interactions, into transactions, a few other things. We've got the AI working hard, training up for categorization, a few other things. Now, obviously, for some people, that's business. We're doing it for obviously passive households and budgeting, not necessarily for business. So watch this space. There's something coming in that area.
There we go. Hey, mate, what's making property news?
Oh, Bryce, a couple of weeks ago it dropped. Sort of 4 times a year I get excited about looking at population because I want to see what sort of trends that are happening in the population space. So, Bryce, what we saw drop a couple of weeks ago is the December quarter population movement. So for those who are new to this type of data, it's important to understand. We see here that we've got 27 million people who are now in this country. It's 27,400,000 people, and 13 to be exact at 31st of December. You can see there population quarterly growth was 91,000. The annual growth is still 445,000 people. But what does it really mean? I just want to go straight to the main data. So what we can see here is this is the population movement into the different states and territories. So we can see here natural increase, which is births over deaths. Then you've got the interstate migration, and then you've got the net overseas migration. And then you sum all of those numbers up, and you can basically start to see the trend. So you can see here in terms of net interstate migration, New South Wales lost 28,000 people. Victoria lost 3,200. Queensland had a strong gain of 5,000. Then you've got South Australia had a net loss as well of 1,500. WA also got a very strong 12,600 in, and pretty much everyone else was going backwards. So let me summarise the overall gains so people can understand what's going on here, because this is really important. New South Wales had a net gain of 108,000 thanks to the immigration story. So 1.3% change. Victoria had a net change of 132,500 people. That is Victoria's only superpower. Everything else is crap, but that's its only superpower at the moment.
But it's superpower. It actually helps.
Very significant. It is. So as long as Victoria can keep attracting people here, because the other problem is, if, for those of you who are old enough, if you know Joan Kerner and John Cain period, everyone moved to Queensland and the place became a ghost town and it was a bloody disaster. Banks collapsed, building societies collapsed. And so we have a massive debt problem here in Victoria, but that is the only thing that's going to trade us or have any hope in hell of trading us out of that debt problem, because businesses are also choosing other states and territories to set up in. In terms of Queensland, 102,700 net gain. South Australia had a net gain of 20,000, again through immigration. WA, this is the other two, that had a 2.4% increase. So the strongest population growth was 70,000 people off us. And if you think about that, there's only a small corridor where most of those people live, in the Perth and the sort of down towards Busselton. That is the little population hub, right? So whereas Queensland, you've got large sort of regional towns right up the coastline. And so the vast majority of those people are coming in to what you might call that Perth basin or that Perth coastline. So that bodes well for also the Perth property market as well. Then you've got Tassie, 1,500 net gain, ACT, 3,100 net gain, and then, Northern Territory, I should say 3,100, and then the ACT 6,800, but anemic compared to the other markets. And in real terms, again, same argument for Darwin. Most people aren't moving to Alice or into Katherine, which are their only other two sort of centres. So that strong population growth is actually happening in Darwin, and we're already seeing that Darwin is the best performing capital city at the moment. We'll do a property mid-year market update soon, but that's proving true as well. So you've got Darwin as the hottest market. You've got Melbourne sort of starting to show that sentiment, and that investor activity coming in because it's so cheap, because it's been poorly run as a state. But ultimately, that's what we're looking at there. So you want to start looking at these trends. And remember, we've taught you about decade-long trends, but this is the sort of stuff that you need. You need economic activity to attract people. And then when you attract that, because if let's say Victoria was to falter and Melbourne was, then that population will move out. And that will be a contagion because new businesses won't start. And that's why I've been so anti-government here in this state, because of their poor ability to actually attract new investment and look after businesses. Because if businesses don't start up, you won't have any jobs. And so that's why I'll put that always there as an important thing. Governments have one job, Bryce. What is it?
To govern for the people, not for themselves.
To run a strong economy. That is it. Everything else takes care of itself. If you're not running a strong economy, you shouldn't be in government, because a strong economy gives you the money to provide the services to the community. In other words, govern for the people. But if you spend it before you earn it, you're going the wrong way about it. So that's an important message for everyone. But there you go. I'll get off my soapbox now, my little data soapbox, Bryce. But that's the population wrap.
Ben, on page 66 of our new book, we had this little image of a bath with the water overflowing, and all you've done there is reinforce that image, because there was not a single spot there that was in the negative, and largely because we've got so many people coming from overseas, which is why property is something that we're internally excited about and optimistic about going forward, which is the opposite to what you talked about with Japan, is because there is no congruence between our immigration policy and our housing policy. And so therefore the people who actually own one are the beneficiaries of that lack of congruence. So all that's done is just further reinforce that cartoon that we put in the book there, Ben. But well done, well played, well said. Thank you for your contribution today, as always. The question that we're hoping everyone is asking themselves right now, Ben, is what would Ray do? What would Howard do? What would Charlie do? What would Warren do? And what would Peter do when they're making their decisions? So bit of fun. Hopefully that's a bit of fun as our community mate. But until next week.
Knowledge is empowering, but only if you act on it.
See you next week, folks.